Hi guys, it's Mosh. Welcome back to another one. If you're new here, click on that subscribe button. Today we're going to look at important subject, UK taxation in terms of a trader or an investor. The first thing to look at is personal allowance. That will determine how much tax you pay on other things as we go through this video. Now, personal allowance is your normal income you get from your normal job. So the first £12,500 is tax free. Okay, so if you earn less than £12,500, you're paying no tax. Now, if you earn between £12,500 and £50,000, you pay 20%. That is the basic rate. So you're a basic rate taxpayer if you fall within that amount. From £50,000 to £150,000, you pay 40% tax on just that amount that you earn between £50,000 and £150,000. And anything above £150,000 is 45%. Remember, you don't pay tax on your whole salary. It's done within those brackets you're taxed at. Okay, next we'll look at the capital gains tax allowance. Everyone is allowed £12,300 capital gains tax allowance. This is just in relation to investing and trading. So if you made £12,300, it's all tax free. However, if you go beyond that, so let's say you made £15,000, from £12,300 to £15,000, that difference, you have to pay 10% as a basic tax rate payer. If your income falls within the higher tax bracket, you'll have to pay 20% on that amount that you made, anything over £12,300. Now, I know a lot of traders, they do CFD trading, so they're trading on margin. One thing people don't realize is CFD is taxable. So if you go beyond the £12,300 amount, you're paying 10% tax, assuming you're a basic rate taxpayer. People don't realize that there's something called spread betting, which works in a very, very similar way to CFDs, but is completely tax-free in the UK. Next thing we'll look at is a stocks and shares ISA. You get a £20,000 allowance as a UK resident. Now, Trading 212 have a completely free, commission-free stocks and share ISA account that you can open. And if you want to start that and start it with a completely free share worth up to £100, all you have to do is use my link in the description box below, deposit £1 and they'll give you a free share worth up to £100. The only incentive I get is I get a free share too, and as you can see, that I have received, if I go into the app, I have been getting a lot of free shares. So thank you for those that are using the link. That means you're getting a free share as well. Next thing we're going to look at is the dividend allowance. A lot of stocks pay dividends. Now, annually, you're allowed a dividend allowance of £2,000. If you earn more than £2,000 in a tax year, as a basic rate payer, you'll have to pay 7.5% tax on those dividends. As a high rate payer, it's around 32% you'll have to pay. Another thing to be aware of, and I've mentioned it in my previous video, is that if you buy US stocks and they pay dividends, the US government takes 30%, something called a withdrawal tax. Now, if you fill in a W8 Ben form, that reduces to 15%. So that's one thing you have to be careful of when buying US stocks. You're actually paying 15% tax on any dividends you earn. And then if you go above that £2,000 threshold, you're paying the UK tax. The next thing is the enterprise investment scheme. Now, I actually bought shares in Carwow, Podpoint, loads of startup companies. And what the UK government do, they give you a 30% back on your investment. So if you invest £1,000, the government will give you £300 back. I did do a whole video on that. If you want to watch that, click on the card. Now, the way you get your money back is through income tax relief. So if you're earning in a normal job and you've invested, let's say £1,000 into a startup company, okay, the government will give you that value, the 30% of £1,000 is £300 back as a tax rebate. It's definitely worth looking out for startup companies. I made a really good investment on this company called Podpoint. They make charging points in the UK and putting in the infrastructure quite in the early days, probably about 5-6 years ago now. And EDF bought out that startup company, 100% of it, for £134 million. So I did make a decent amount on that investment. Plus, I got a tax rebate as well. Another alternative of the EIS is the SEIS, the Seed Enterprise Investment Scheme. They're companies that need to get started up and need capital. The government give you a 50% tax rebate. So that is really good. If you invested £1,000, the government will give you £500 back. And obviously that will reduce in your income tax. So it's definitely worth looking out for companies that are SEIS approved. Just be aware, I'm not a financial advisor. I'd recommend getting a qualified accountant to look at all your taxes and how much you need to pay and see where they can save you money. So that's always good to do. I hope you enjoyed this video. Please go like and subscribe, as this allows me to figure out what type of videos you guys enjoy.